A sales leaseback can be the most powerful capital tool in healthcare real estate. It can help fund your next 5 locations without diluting your equity, without stacking up personal guarantees, and without talking to a bank. It can also destroy 5 to 10 million in enterprise value the day before your private equity exit if you get 3 variables wrong. The difference between those outcomes is not luck. It is not market timing. It is deal architecture. And most operators and most brokers, well, they don't know the difference. I've spent my career helping to structure and develop over 100 ground-up healthcare clinics. I've sat on the side of the developer, and I've sat in an advisory capacity to operators. Today, I'm showing you how the sale-leaseback may be the smartest capital play you've ever made, or maybe the most costly. First, the frame, because this changes how you hear everything that follows. If you watched my last 2 videos, you know that I'm a big believer in a sale-leaseback strategy. It unlocks net equity. It can convert frozen assets into liquid deployment capital. For operators scaling from 3 clinics to 10, or from 20 to 40, it can be the single most efficient capital strategy out there. But a sale-leaseback is a financial instrument, not a philosophy. And like any instrument, it has a context where it performs brilliantly and a context where, well, it does damage. The problem is that most operators encounter a sale-leaseback through a broker whose whole incentive is to close the deal, not to evaluate whether the timing, the structure, or the buyer are right for that specific operator's trajectory. Today, I'm giving you the evaluation framework. 3 variables. You get them right, and the sale-leaseback can accelerate everything. Get them wrong, and you're handing enterprise value to the other side, and you won't even realize it until closing day. Here's the part that matters if you're on the investor side of the deal. Understanding these variables, well, they make you a better buyer, because sale-leaseback transactions that blow up, you know, the ones that fail in year 5 and you inherit a vacant medical office, almost always trace back to the same structural misalignments that I'm about to show you. A well-structured sale-leaseback protects the investor's asset just as much as it protects the operator's margin. Variable 1, timing. The variable that determines whether a sale-leaseback funds your growth or discounts your exit. The single most important variable in a sale-leaseback is timing, specifically where you are on the calendar in a private equity exit or recapitalization. Here's why. When you sell a building in a sale-leaseback, the buyer prices the building based on a cap rate, typically 6 to 7.5% for a stabilized, long-term healthcare asset. That capital comes in a lump sum, and it's real capital, liquid and deployable. But you also create something, a new rent obligation. And that rent comes directly from your operating income. The capital is in your bank account, but your EBITDA on your P&L just took a permanent haircut. Now, if you're 36 to 48 months away from a private equity event, that haircut doesn't really matter. And frankly, it may be an advantage. Here's the optimal scenario. You own 2 buildings. Combined appraised value is $2.4 million, remaining mortgage debt $600,000. You execute the sale-leaseback, pay off the mortgage, and walk away with $1.8 million in liquid capital, typically within 60 to 120 days. You deploy that $1.8 million into 6 new locations at $300,000 per operational line. Staff, equipment, marketing, patient acquisition. Each of those 6 locations follows a standard healthcare ramp curve. Credentialing clears, referrals build, word of mouth compounds. Within 18 to 24 months, each location matures to approximately $250,000 in annual 4-wall EBITDA. That is $1.5 million in new annual EBITDA from those 6 locations alone. Now subtract the cost. The sale-leaseback created a new rent obligation on the 2 buildings you sold. The 2 locations you previously owned outright with no rent expense. At a 7.5 investor yield on $2.4 million in purchase price, that is roughly $180,000 per year in new rent on locations that used to cost you $0 in occupancy. That $180,000 comes directly off your trailing EBITDA. Your net EBITDA gain is $1.5 million in your new clinic revenues minus the $180,000 in the new rent obligation. That gives you $1.32 million in net EBITDA. At a 10x multiple, which is a reasonable multiple for a well-run multi-site healthcare platform, that $1.32 million in incremental EBITDA equates to $13.2 million in enterprise value, created from the $1.8 million in redeployed capital. That's a 7.3x return on the capital deployed from the sales leaseback. That is the instrument working exactly as designed. Variable 2, structure. The sale leaseback is a 2-part instrument. The sale and the lease. Most operators only negotiate one of them. The second variable is the lease structure inside the sale-leaseback. And this is where most operators make their most costly mistake. Not because they negotiate badly, but because they negotiated the wrong thing. When a broker structures a sale-leaseback, their incentive is to maximize sale price. That's how they make their commission. And the way to maximize the sale price for the investor is to offer aggressive lease terms, high base rent, 3.5% to 4% annual escalators, continuous operations, and other incentives. From an investor's perspective, those terms make total sense. They're buying a cash flow stream, and a higher base rent combined with aggressive annual bumps, that gives them a better yield, which means in turn that they'll pay a higher price for the building. That is rational economics on their side of the table. But here's where the misalignment happens. If you watched one of the last videos on the 3% clause, you already know the problem. Healthcare reimbursements are essentially flat. CMS sets rates. Commercial payers, well, they benchmark to CMS. Your per visit revenue likely does not compound at 3.5% annually. So you have created a cost structure that grows faster than your revenue structure inside a lease that you cannot renegotiate for 15 years. The rent coverage ratio exposes this in real time. It is your four-wall EBITDA, the annual operating profit at that specific location, divided by your annual rent obligation. A healthy clinic maintains a coverage ratio between 3x and 5x. That means for every dollar of rent, you're generating $3 to $5 in operating profits, and that's a healthy cushion. Now watch what a 4% compounding escalator does to that ratio over a 10-year lease term. Assume your location generates $300,000 in annual four-wall EBITDA with modest 2% organic growth. Your starting rent is $72,000, a $200,000 building at 7.5% investor yield, which is fairly standard for a healthcare net leased asset. At lease signing, your coverage ratio is 4.2x, healthy. Year 3, your EBITDA has grown to $312,000. Your rent has compounded to $81,000. Coverage 3.9x, still fine. Year 5, EBITDA at $324,000. Rent at $87,600. Coverage 3.7x. Adequate, but the trend line is visible. Year 8, EBITDA at $344,000. Rent at $98,500. Coverage 3.5x. You are starting to feel it in your margins. Year 10, EBITDA $358,000. Rent $106,600. Coverage 3.4x. That looks manageable in isolation, but here's where it becomes dangerous at scale. Multiply that across 10 to 15 locations with a 4% compounding rate. The aggregate rent coverage versus a 2% annual escalator is over $300,000 per year by year 10. That $300,000 comes directly out of your trailing EBITDA, and at a 10x multiple, that's $3 million in enterprise value gone. Not because any single location failed, but because the lease structure was misaligned with the revenue structure across the portfolio. And here's the part that protects the investor too. If your margins erode to the point to where they become economic, you close the clinic. The investor now owns a specialized medical shell, and healthcare real estate does not backfill like retail. That vacancy can cost the landlord 12 to 24 months in carrying cost, in addition to multiple six figures in re-tenanting cost. An investor who understood the operator's margin reality would have negotiated a sustainable escalator, because a stable tenant paying 2% annual bumps for 15 years is far more valuable than an aggressive tenant paying 4% annual bumps for 7 years and being left with a dark building. The fix is the same framework I covered in the escalator video. CPI collar capped at 2%, a step-up structure that matches your revenue curve, predetermined escalators through every option period. But inside a sale-leaseback, you have a unique advantage. You are architecting the lease from scratch. There is no existing landlord forum to negotiate against. You set the terms. You can use that advantage. If you're sitting there thinking about a sale-leaseback that you've already executed, or maybe one that you've got papered and getting ready to finalize, right now is the time that most operators go and they pull the leases and start looking through the escalator clauses and maybe some of the other clauses that we've talked about. And what they find is oftentimes some of the people on their side maybe didn't ask the right questions when it mattered. The good news is that it's fixable, whether it be at renewal, at refinancing, or especially if you're in the middle of structuring that sale-leaseback right now. But only if you have somebody on your side that understand how both sides of the deal think. If you want me to take a look at your sale-leaseback, whether it be a past, a present, or one that you're negotiating in the near future, and just determine whether or not the timing, the structure, or the counterparty works for you or against you, then book a strategy session. The link's in the description. It's 30 minutes, no pitch, no obligation, just the audit. One more thing before we get to variable 3. This is the one that most operators never really consider, and it could be the most important of all. Variable 3, counterparty. The sales price is the number that everybody negotiates. The counterparty is a variable that determines what will happen for the next 15 years. Variable 3 is the one that almost no one thinks about. Who is buying your building? Because not all sale-leaseback buyers are the same. Their hold period, their return requirements, and their operational expectations are fundamentally different. And those differences will shape your lease, your flexibility, and your risk profile fundamentally for the next decade or more. Let me walk you through 4 buyer profiles. And I want you to notice something. None of these buyers is wrong. They are all executing on different strategies. You just need to understand if their strategy aligns with yours. Buyer 1, the 1031 exchange buyer. This is typically a high net worth individual or family office who are rolling sale proceeds from a previous deal into your property to defer taxes. Their priority is not yield maximization. It is tax structure and stable income. They need to deploy capital within a specific window, and a stabilized healthcare asset with a creditworthy tenant checks every box. For operators, this could be the most favorable counterparty. Because the 1031 buyer is solving more of a tax problem, they are often more flexible on other lease terms. Moderate escalators, 2% annually or CPI capped, clean covenant language, and minimal reporting. They want simplicity and durability, not maximum extraction. The trade-off, they are buying one building, not funding your whole platform. If you need a portfolio-wide solution across 5 or 6 properties, a 1031 buyer typically cannot provide that for you. But for a single property sale-leaseback with clean terms, this is often the best match. Buyer 2, the Net Lease REIT. REITs are institutional buyers that acquire net lease assets at scale. They have dedicated underwriting teams, standardized lease templates, and return hurdles that they must hit for their shareholders. They are professionals. They've done hundreds, if not thousands, of these transactions. They will often pay a stronger price, with a tighter cap rate, sometimes between 50 and 100 basis points, because they have lower cost of capital and they're oftentimes building a portfolio. But the lease will have teeth. Expect continuing operation clauses, financial reporting requirements, and other items, especially if they are buying multiple properties from you. Those covenants are not punitive. They're protective. The REIT is answering to shareholders and to rating agencies. They need assurances that their tenant will operate continuously and maintain financial health. For a large, well-capitalized operator with clean financials and great unit economics, a REIT can be the ideal partner. Best price, institutional credibility, and long-term relationship. For a smaller operator, the covenant package can become operationally restrictive and create difficulties during a private equity due diligence round. Buyer 3, the private equity real estate fund. Private equity real estate funds are underwriting to specific return targets, typically 15 to 20% internal IRR over a 5 to 7 year period. They need aggressive economics to hit that target, which typically means higher base rent, steeper escalation clauses, and lease clauses that allow them to compress the cap rate when they go to sell in year 5 or year 7. For operators, there are 2 risks here. First is the lease is structured to match the fund's math requirements, not to match your margin reality. A 3.5% and 4% annual escalator may be acceptable in year 1, but as we just discussed, that compounds aggressively against your revenue increases and really erodes your margin over time. Second, the fund will likely sell the property during the lease term, which means you'll likely end up with a counterparty that you didn't choose. And that new owner may have different expectations, different management, and different enforcement tendencies on your covenants. The highest price often comes from this buyer type, but the highest price and the best deal are not the same thing. Buyer 4, the family office or long-term private holder. These are patient capital providers. They're often underwriting on a 20 or 30-year hold pattern, and they prefer a durable, stable tenant over complete yield maximization. They are often willing to accept a lower purchase price. Think 25 to 50 basis points wider on the cap rate, in exchange for a lease with moderate clauses and a tenant that they believe will occupy the space for the full term. For operators building a long-term platform, this could be the most aligned counterparty. The lease terms are sustainable, the covenants are light. The hold period means you're dealing with the same owner for the duration of the lease term, meaning no surprise transfers and no new management with different expectations in year 4. The trade-off is real here, and it's going to feel like you're leaving money on the table. For example, a $2.4 million acquisition price on a 50 basis point cap rate differential, that's a $150,000 to $200,000 difference in purchase price. The question is whether that $200,000 is worth 15 years of sustainable terms and the operational freedom that comes with it. Let me make this concrete. 2 real offers on the same property. Offer A, PE Real Estate Fund offers $2.2 million purchase price, 4% annual compounding escalator, cross default provision across your other locations. 5-year hold, they will resell. Offer B, family office, $2 million purchase price, 2% annual escalator, clean covenant structure, 25-year hold. On closing day, offer A looks $200,000 better, but run it through the exit lens. Over a 10-year hold, the 4% escalator in offer A creates approximately $45,000 more in annual rent versus the 2% escalator in offer B. That $45,000 comes directly off your EBITDA. At a 10x multiple, that is $450,000 in enterprise value erosion, more than double the $200,000 premium you received at closing. And that does not account for the cross default risk, which a PE buyer's diligence team will flag and price into their offer. The family office deal, the one that looked $200,000 worth on closing day, is actually better for your enterprise value. That is the math that most operators never run. Every framework has an exception, and knowing this one differentiates the operators who just negotiate and those that understand deal architecture. Before I bring this together, I owe you the exception, because no framework is absolute. There are situations where executing a sale-leaseback just before a private equity exit is the right move. If the operator's capital structure is so constrained that it cannot survive the next 18 to 24 months to allow the new clinics to mature. If the choice is between an imperfectly timed sale-leaseback or running out of operational capital, the sale-leaseback is the right move, even including the timing penalty. A suboptimal deal that keeps the business alive is far better than a fantastic deal that never happens just because you ran out of runway. Pulling all this together, a sale-leaseback isn't a good deal or a bad deal. It's a deal structure. And deal structures are only as good as the person who's architecting the structure itself. Variable 1 is timing. Deploy early enough, and the capital creates multiples of the value it displaced. Variable 2 is structure. Aggressive escalators and restrictive covenants may get you a bigger check on closing day, but they erode your margin for 15 years and create a vacancy risk for the investor. Sustainable terms protect both sides. Variable 3 is a counterparty. The buyer's hold period, return benchmarks, and covenant restrictions determine whether your lease is a growth instrument or straitjacket. The right match is not the highest bidder. It's the party whose strategy aligns with your trajectory.